Good morning to those of you on the West Coast and good afternoon to you on the East Coast. I'm Lou Feldman, CEO of Heritage Commercial Real Estate Technology Ventures, and I'm honored to serve as the chairman of the founding board of the University of California, Los Angeles Richard C. Ziman Center for Real Estate. I want to thank you for joining us for our spring 2020 boardcast. We hope that you and yours are safe during this very turbulent time. Due to COVID-19's abrupt entrance into our lives and the immediate need for trusted insights, especially at this time, we've decided to bring our board discussion to you at home rather than wait to convene in person as we typically do each fall and spring. And the Ziman Center intends to continue to deliver valuable content and programming to our community as robustly as possible and as often as possible during these unprecedented times. And for the next 55 minutes, we're going to focus on COVID-19 and its global impact on real estate, the economy, the investment markets, and we have Scott Minerd, founding managing partner of Chairman and Global Chief Investment Officer for Guggenheim Investments. So before I turn to Scott, let me tell you a little bit about our audience. On our broadcast today, we have our founder, chairman of Rexford Industrial Properties, Richard Ziman. We have Arden Realty Chair and Professor of Finance, Director of the UCLA Ziman Center, Dr. Stuart Gabriel. We have our Ziman founding board members, our advisory and sustaining board members, UCLA Anderson faculty members, UCLA Anderson MBA students, UCLA Law School faculty members, and UCLA Law School students. We also have dedicated Guggenheim team members, Annette Erickson, Eric Chung, and Brian Smedley, and our UCLA Ziman Center team members, Executive Director Tim Kalahara, and Director of Advancement Nicole Vermeer, as well as David Long, who is our technical expert. They were essential in planning today's event and executing on it, and I thank them on behalf of all of us at UCLA. And for this distinguished audience, I'm tickled, delighted, and happy to present this timely discussion with Scott Minerd and our Real Estate Center's leader, Dr. Stuart Gabriel. Today, Scott's first going to provide his perspectives on the great pandemic of 2020. Stuart will then join Scott for some discussion and commentary, and then at the conclusion of Scott and Stuart's remarks, we're going to entertain questions from the audience. Now, we at UCLA know what a rock star Professor Stuart Gabriel is. I like to think of him as UCLA's economic Dr. Fauci. And who's sexier than Fauci today? Stuart Gabriel with that beard. But let me offer a little more background on our speaker, Scott Minerd, as well, who's also an analytical rock star and would no doubt be inducted into the Rock and Roll Hall of Fame, where they're one for business and were it not located in Cleveland. Scott's insight, command of economic tools, and depth of analysis are second to none, whether the topic is real estate, climate change, what the Fed's going to do, or the prospects for the LA Dodgers. Guggenheim Investments is the global asset management and advisory division of Guggenheim Partners and has more than $215 billion in assets across fixed income, equity, and alternative strategies. Guggenheim focuses on the return and risk needs of insurance companies, corporate and public pensions, sovereign wealth funds, endowments, and foundations, as well as wealth managers and high net worth investors. In addition to serving as Global Chief Investment Officer of Guggenheim Partners and Chairman of Guggenheim Investments, Scott's also a member of the Federal Reserve Bank of New York's Investor Advisory Committee on Financial Markets. He's an advisor to the Organization for Economic Cooperation and Development and a contributing member to the World Economic Forum. We see Scott regularly featured in leading financial media outlets, including Financial Times, Barron's, Bloomberg, CNBC, Fox Business News, Forbes, and Reuters. Scott's a personal friend of over 20 years and one of the truly good guys in life who puts his heart, time, and philanthropic resources into making a difference in the lives of others, including graciously and generously sharing his thoughts today with our UCLA real estate and business community. So let's begin. Ladies and gentlemen, I'm going to turn this over to Mr. Scott Miner. Thank you, Scott.
Thank you, Lou, and thank you for the very generous introduction. I'm honored to be here today, and before I do start, I'd like to acknowledge the work of Brian Smedley and our research team who assembled the materials today on pretty short notice so that we could give you sort of the up-to-date view that we have on the current situation. The question now is, if we go to slide 1, is, where are we now in this process? And when we look at slide 3, we see that despite the progress in Europe, the coronavirus is still, that's slide 4. The previous, there it is, slide 3. The coronavirus is still a major problem. You can see that the United States, that's the portion at the bottom, continues to rise in general. But there is some hope here that the rate of increase in cases is starting to decelerate. When you look at the data and you listen to the policymakers, the prospects of us ending the current lockdown are that we will have to wait until we see the total number of cases start to decline. The first step here will be to essentially slow down the new cases, and then after they're resolved, then we will slowly see the total number of cases start to turn over and decline. To get perspective on this, if you go back to China, where we first observed the coronavirus, around February 15th, the cases began to flatten out, the total cases, and to date, they've yet to turn down. When I hear Fauci talk about the pandemic and how it would be addressed, he suggested that we couldn't really start to return to a normal life until we see those number of cases decline. So now, we're roughly 8 weeks since the curve flattened for China. And I think that gives us some idea about how long it will be once the curve flattens that we would expect things to see the curve start to turn down. Using the estimates from just watching the pandemic in other countries, at any given moment, once we start to see the deceleration in the total number of cases and see the curve start to flatten out, it will take about 10 days before the curve has flattened out completely. So the reason I bring this 10 days up is, as we sit here today on April the 8th, we know that it's going to be at least April 18th before the curve flattens. And the risk is, of course, that it's going to be longer. And then using the China experience, we know that that even after the curve flattens, we've yet to see a downturn in number of cases, even though now it's 2 months later. So if we take Dr. Fauci literally at his word, that we're not going to be able to get back to normal until we see the number of cases coming down, then we're talking about somewhere in the middle to late June before we will start returning to normal. All of our estimates, however, that you're about to look at are premised on the idea that we have some prospect of returning to normal by the end of May. So perhaps the projections that we're about to see may be proved to be optimistic. And when you hear some other firms in the market, which I'll highlight as we go along, you'll see that we do look optimistic. As you can see on this slide 4, we have had a model we've been using for years that correlates the unemployment rate to Google searches related to unemployment. And you can see the sharp spike in the searches, and that gives us an idea that unemployment should rise to somewhere, at least at this point, in the 17 to 19% range. That's not to say that's where it's going to peak, because just last week, if you had me talking, I would have said that the chart showed we would have peaked between 15 and 17%. And certainly these estimates are well below the estimates, for instance, of James Bullard, who is the president of the St. Louis Fed, who has said that he expects unemployment to rise to 30%. So certainly our expectation at this point, in the way we're looking at the world, is that unemployment won't be as bad as advertised, but nevertheless, this is all subject to revision as we get more data coming in. When you go to the next slide, you can see that there's a robust relationship between unemployment and GDP. And so given our projection of 15% average unemployment in the second quarter, that would be consistent with an annual rate of GDP for 2020 of around negative 12%. So that is for the entire year. That is not for the next quarter. Our view for the second quarter is that GDP on an annualized basis will contract at a rate of 40%. And I want to make clear that people understand that that's annualized, which means that represents 4 quarters. So really on total terms, GDP would be collapsing by 10%, meaning if we are a $2.2 trillion economy, a $22 trillion economy, that we would have about $20 trillion, $19 to $20 trillion of economic output in the second quarter. Again, that may be too optimistic. I've seen estimates of down 50 to 60%, which again, I think is not to be unexpected. When you look at the next slide, obviously the coronavirus has given an opportunity to the Russians to use this as a means to try to crush the United States oil output. And so Saudi Arabia and Russia continue to pump a lot of oil. What you can see here is that this is the excess supply of oil, that is the amount produced minus the amount consumed for the 4 quarters of 2020. The forecast that we're using here is that we do think that there will be some sort of deal between Russia and Saudi Arabia and other oil producers. But the model that we're using is that we assume that they'll bring 10 million barrels a day of production offline. If that's the case, then you can see that even with that in place, you can see that in the second quarter, we would expect that excess production will be approximately 15 million barrels a day. And when you look at that purple line, with the dash representing our estimate based upon the light blue bars, you can see that is the total inventory of oil in the world. So there is, of course, a correlation between the levels of inventory and the price of oil. And again, when we model this, if we were to follow the dashed line, which I think is highly likely, then the models actually tell us that oil will go to a negative price. Now, that's not our forecast. We're saying that we think oil will go to somewhere between $5 and $10. That would be consistent with where oil went during the Asian crisis in 1998. But the prospect or the idea that some oil producers may actually be paying people to take oil off their hands is not unrealistic. When I've spoken with various oil producers, the comment I get back is that in the short run, it may be make more economic sense to actually pay people to take the production off their hands than to try to shut down production, which has in its own self certain costs associated with reducing production. So, you know, while the models point to the possibility of negative oil prices, not our, as I say, not our base expectation for the total market, but at the end of the day, we do think that some oil producers will be paying people to take oil off their hands. One of our biggest concerns right now, because as you know, I wrote a piece a few weeks ago called "The Butterfly Effect," and for those who didn't read the piece or are not familiar with the butterfly effect, the hypothesis is that a butterfly flaps its wings in Brazil, and you get a hurricane in Europe. And so the point that is trying to be made in the butterfly effect is that often small things, or seemingly unimportant things, can have broad unintended consequences somewhere else in the world. Certainly, when I wrote the butterfly effect, what I was talking about was the idea that the coronavirus had given rise to a geopolitical incident involving Russia and a desire to destroy U.S. output of oil. But you know, the question in the piece that I asked is, and then I stated, it's virtually impossible to tell what the next shoe to drop will be. And but one of the places where we're highly focused is in the emerging markets. When you look at slide 7, this is the total emerging market debt to GDP, both private and public sector. I don't know if we can get that slide up. The one before that. There it is. If you go back and look at 1998, way over on the left side of the screen, you can see that during the Asian crisis, the total debt to GDP of the emerging markets got to 115%. Today, the total debt to GDP is around 180%. Now, people who are familiar with the Asian crisis will point to the fact that a large percentage of government debt in the emerging markets back in 1998 was denominated in US dollars, and as the currencies in Asia lost their value, it became harder and harder for the governments to access dollars and to service their debt. Of course, at the end of the day, there was a global plan arranged to bail out the emerging markets, and the International Monetary Fund, the IMF, basically stepped in and provided the support necessary to help those governments out. Probably the most disturbing aspect of the current situation is that there today is record levels of dollar-denominated net coming out of the emerging markets, but this time it's not the public sector, it's the private sector, it's corporate debt. And a lot of this corporate debt got to come into existence by virtue of the aggressive interest rate policies by central banks around the world over the last decade, which made it very attractive for emerging markets countries to start borrowing. And sure enough, when you look at the chart, you see 2009 where we were and how debt has exploded to the upside. Of course, if this were back in 1998, we would say, well, we've seen this script before, and the IMF will step in and bail out the countries. But now we're dealing with the private sector, and there is no standing mechanism to help bail out the private sector. So as this would play out, what we would expect is that emerging markets countries, just like the United States, will see their economies slow, which they currently are, and that there will need to be more fiscal stimulus from the governments, which will require them to borrow more money in their domestic bond market. What we're seeing in the emerging markets, the Philippines, Indonesia, Brazil, and others, is that sure enough, we're seeing and Mexico, as examples, we're seeing government bond yields in local currencies rise at the same time that that rates here in the United States have fallen. The increase in rates, of course, eventually will choke the domestic economy. And so the solution to this is exactly the same solution we have in the United States, which is the central bank steps in and starts buying government bonds to help facilitate financing the deficit in those countries. However, when the central bank does this, that of course creates more local currency, and that drives down their currency versus the dollar. And then it makes it harder for the private sector to get access to hard currency because the local currency is dropping, and it's increasing their debt burden just at the time their businesses are slowing down, and you start to see a cascade of defaults. So in support of that theory, if you go on to slide 8, you can see that the hot money in the emerging markets has been piling up over the last decade on the left. And on the right, you can see the outflows from the emerging markets countries ever since the coronavirus. So as you see there, just about a month ago or so, we were basically sitting around the zero level, meaning there had been no change. And then as the coronavirus epidemic began to spread, you can see that there was a precipitous decline set off in the outflows of US dollars coming out of the emerging markets. So this trend is continuing. Policymakers are aware. The Federal Reserve, for instance, just this weekend put a $60 billion line in for Indonesia to, basically get dollars in exchange for rupee. But at the same time, it's not just a matter of getting hard currency into the hands of the bank or the governments. It's getting the hard currency into the hands of the private sector. I think that given the current political environment, if we were to try to orchestrate a bailout like we did for Mexico back in 1994, or like we did or in 1995, and then a bailout for, no, it was in 94, sorry, getting old, I can't remember, or a bailout like we did for Asia in 1998, I'm not so sure, given all the other demands on the United States at this time, that there would be support for trying to arrange an international bailout of the emerging markets. But nevertheless, it's on the radar screen of the IMF. They've talked about it over the weekend to try to orchestrate international support. I just haven't seen much groundswell for the support. Moving on to slide 9, when you look at the fixed income markets here in the United States, most markets are well into the value zone. You can see here that in many cases, a lot of the securities that are trading, leveraged loans, high yield, investment grade corporate bonds, are in the top, the cheapest 5% range relative to US Treasuries that they've been historically. The only exception on here, as you can see, is agency mortgage-backed securities, agency mortgage-backed securities, which are eligible for Federal Reserve purchase, and then the non-agency CMBS, which has held up AAA CMBS, which has held up relatively well, whether it deserves to or not. So we are, in the value zone. One thing I tell people when we get to these situations is things that are cheap doesn't mean they can't get cheaper. Matter of fact, if you look at the next chart, you'll see for investment grade corporate debt spreads relative to US Treasuries, how wide we got in the current sell-off, around 375 basis points differential between Treasuries and corporate bonds. This is as of yesterday. We were around 275%. You can see that below there, that 95th percentile cutoff, close to just below 250. So we are still in this 5% tail. But as you look back, there are a couple of observations to make. One is you don't tend to just stay in the tail for a short period of time. It's hard to see on the chart, but when you look even at the 2002 recession or at the spike we got back in 2012 in credit spreads, the period can go on for a number of months before it reverses itself. Of course, that big bulge there is Lou Feldman's wallet. No, I'm sorry, is the global financial crisis. And there is an argument to be made that the economic conditions today are worse than they were in the global financial crisis. Certainly the unemployment rate looks like it's going to be worse. Certainly the decline in economic output is going to be worse. But the one thing that we have going this time that we didn't have going back in the financial crisis is the rapidity at which there was a policy response out of Washington to try to help salvage the markets. One of the things we'll talk about in a minute is that policy response and how effective we think it is being. When you look to the right, again, just the same chart, but here all we're doing is charting the spreads in percentiles, and you can see by both definitions, corporate bonds are exceptionally cheap. One of the reasons corporate bonds are so cheap is demonstrated in slide 11, and that is that, and maybe why they're cheaper than they were in the last recession, is for the first time ever since we've kept records on the corporate bond market, which goes back into the 1920s, there are more than 50% of all corporate debt is rated BBB. And so obviously BBB credits are the ones that are more vulnerable to being downgraded into below investment grade. And one of the troubling aspects right now of the current situation in corporate bonds is that a lot of companies currently, before we got into this recession scenario, had demonstrated that they were of BBB quality. For instance, Kraft Heinz was a very good example. That company was rated BBB. When you looked at their leverage ratios, the company was clearly a BB credit based on leverage ratios, but in terms of interest rate coverage, they would have been thought of as an investment grade credit. The answer to this problem was a representation that Kraft Heinz made to the rating agencies that they were going to delever their balance sheet. Obviously, when they posted their latest financial results, the rating agencies lost patience with them and said, look, you haven't made adequate progress, and so they downgraded Kraft Heinz to BB. There are a lot of companies like that. We have identified approximately $1 trillion worth of corporate debt, which fits into this category. So our estimate is, in any given year, we think the downgrades from BBB to below investment grade will peak around 600 billion. But when you look at the cumulative downgrades between today and the end of 2022, we think that we will have over $1 trillion worth of investment grade debt migrate to high yield. In the scale of things, the number is quite disturbing because today the high yield market is about $1 trillion. So the new supply that's coming on the market will have to be absorbed by below investment grade investors just at a time that a lot of people are paring their risk and trying to reduce their allocation to below investment grade. What that means is that the prospects are those spreads that we were just looking at for high, we didn't see the high yield spreads, but it's a similar pattern to the investment grade spreads, that they're going to have to widen significantly more than where they are today to get the market to clear, unless there is some sort of government intervention. Moving on to slide 12, a big topic has been the rally, the rapidity of the decline, and the strength of the rally that we've had so far. The decline from peak to trough has been around 38%, and the recovery from the trough to where we are today is about 37%. Now that may sound like, wow, that's almost everything, but when you do the math, I always like to start with a simple example, which is if a market goes down by 50% and then recovers by 50%, you're still down 25%. And sure enough, as we sit here today, we're still down almost 20% from the high. A number of people have queried me and said, well, this tells us that all the government programs are working and that maybe the worst is behind us and that we've already got things kind of patched up. But I point to basically every bear market in stocks which has been associated with a recession, but for brevity, I only included two. The first is the 1929 bear market. You can see that in that market, the first initial sell-off was down 45% over 58 days. And then we rallied by 47% for the next 148 days, and then began a sickening slide that took us down 83% in 783 days. If you want to look at something more recent, you can go back to 2007, where the market's initial sell-off was down 19% going into 2008. The market rallied 12% and then proceeded to decline by 53%. So it is not unusual in bear markets, especially in recessions, to have a major retracement of the decline before the sell-off resumes. So I wouldn't necessarily be looking at the recent market stability as a sign of that we are somehow out of the woods or that things are improving dramatically. As a technical matter, being an old bond trader, the rally that we've had over the last 2 weeks has been on relatively light volume. Light volume rallies are typically associated with corrective moves, meaning that it's not the primary move. And so people say, well, why is that significant? And why it's significant is that what it's telling you is there's not a lot of people trying to buy the market, but the majority of people are still hanging on, hoping that prices are going to rise and bail them out. And so a little bit of demand pushes prices up a lot. And so people are caught at the highs with significant positions, and they're holding out. And by the way, just so for dynamic here of what I was just discussing, we're seeing the exact same thing occur in the asset-backed securities market. CMBS securities, CLOs, all sorts of securitizations. Our AAA securities are trading okay. You can move a couple of $100 million a day in the total market, but once you get below AAA, most of the securities just are offered with people looking for bids. And as an example, if you look at something like BBB CLOs, they're offered around 70 cents on the dollar, and the bid is around 40. So those markets are at a level practically not functioning, and we will come back to that and what the implications are for the policymakers. But going back to the stock market, if we go over to page 13, we can see here that we've developed a model. Again, I give credit to Brian and his team for doing this, that we've been using for years to tell us where we should expect the stock market to go in the next recession. And this is, largely based off of things like unemployment and other factors. And you can see that in some years, the blue line, which is the projection, is worse than what the outcome is. In some cases, it's actually better than what the outcome is. So you can see what the model predicts here. The model predicts almost a 70% decline in stocks from the peak, which if we talk about this in terms of the S&P 500, we're talking about somewhere around a level of 1,000, maybe a little bit higher. It's interesting. Again, I have to go back and put on my trader hat. And when you look at a technical analysis of the stock market, we have pretty strong support for stocks around 1550 on the S&P 500, because that was the old high in 2007 and it was the old high in 2001. Typically, you don't go below the old high that you broke out from. When people have challenged me on this, for instance, the Federal Reserve did in a piece I wrote. I said, well, look, let's just look at this simply. If you use Ed Hyman's projections, Ed is at ISI, which is part of Evercore, and he's probably the best macroeconomist in the world. His projection on S&P earnings for 2020 is $100. If we use the historical market multiple of 15, that gets us to 1,500 on the S&P. It sounds awfully close to the number that I was throwing out, and sounds perfectly reasonable. If you look at the market multiple where we were at the height of the great financial crisis, at the bottom of the market, that multiple was 12 with depressed earnings. That means we would go to 1,200, which is closer to the number that our models are throwing out. If you go to the rally that occurred, and then the secondary sell-off we got in 2012, the multiple there was 11. So, that argues even for a lower number. If one of the Fed presidents I spoke with challenged me and said, well, Scott, $100, okay, let's go with it. But, there's going to be a meaningful rebound quickly by 2021. And so, he said, citing the same estimates, he said, that's $120. And my response to him was, look, okay, let's assume a PEG ratio, that is a price-earnings ratio relative to growth, which is a common valuation technique in markets that are rapidly rising with earnings, and say it's a 20% increase in the value of the market. So that means the PE should be 20, which puts us at 2,000. It's hard to argue for a bigger number than that. You can see that whether you want to say 2,000 or 1,600 or 1,200, whatever number you want to pick as the bottom, it doesn't really matter because we're nowhere near it, no matter which one you pick. By the way, given where we're trading today, we would be trading at 27 times earnings, which is a kind of multiple we got during the internet bubble, when we were looking at a future where people were projecting rosy forecasts into the future and trees are growing to the sky. I don't really think that the current environment looks like that. So I think that 27 times earnings is probably, we're safe to say that that's at an extreme and would constitute overvaluation. And so, in all likelihood, whether you want to pick any of those numbers I've put out, it seems that we still have some significant downside from here. Let's say at least 30%. Moving on to the next slide. One thing I tell people, and I started this back in saying this back in 2009 and 2010, is the American people need to have more faith in the willingness and ability of their government to print money. The solution to everything is to print money. And so, this model here, what we're looking at today, is not something that we just thought of last week. This is a model we developed years ago when we were forecasting a recession to begin in the first quarter of 2020. And we started to forecast that back in around 2016. And the idea would be that once we got to a recession, historically on average, the Federal Reserve has had to reduce short-term interest rates by 500 basis points or 5%. And obviously trading in the short-term rates where they were at the time, you couldn't get the 500%. So we had just assumed short-term rates would ultimately get to somewhere between 2.5% to 3%, and then the economy would start to slow. And so therefore the question is, how do you get the comparable effect of reducing rates by 500 basis points? And of course, the way you do it is quantitative easing. And so the Federal Reserve actually has a formula that tells them what the comparable amount of asset purchases would be to be equivalent to like 0.25% cut of interest rates. So just using the Federal Reserve's model back in 2016, we concluded that by the time we arrived at the next recession, the Federal Reserve would have to engage in quantitative easing, and that the balance sheet would have to go to $9 trillion. Today, that sounds back then it sounded kind of crazy. Today, based on everything I'm reading, most people believe $9 trillion is about the right number. And the Federal Reserve is obviously buying assets even at a faster pace than it did during the global financial crisis. So you can see QE1 on the left, you can see QE2, you can see QE3. None of those episodes of quantitative easing resulted in asset purchases at the rate that we're currently going. So now, one of the things I like to remind people here, and I said this in 2008 after Lehman failed, is that the dirty little secret is that what the Federal Reserve is doing is providing credit to finance the U.S. government. I pointed out back then I thought we would see deficits expand from $500 billion to $1.5 trillion, and that there wouldn't be enough domestic savings to finance the deficits. And so, therefore, the Federal Reserve would have to step in at a rate of about $1 trillion a year for a number of years to be able to finance the government without seeing interest rates skyrocket. So when you look at QE4 today, you could say, well, okay, there's about $800 billion worth of domestic savings in the United States. The deficit this year is probably going to approach something like $3 trillion. So given the shortfall between domestic savings and where the need for the U.S. Treasury is to finance itself, we're going to need to do somewhere at least on the order of $2 trillion a year in asset purchases. So you can easily see running for a couple of years in that $2 trillion area. So that from where we're starting here, just around $4 trillion before things really got going, it's easy to see how you get to $8 trillion. And I think I'm probably being optimistic because Nancy Pelosi is working on the next trillion right now. And I'm sure by the time they get done with the White House, we'll figure out how to get it up between 1.5 and 2 trillion. And so I'm not, I am in no doubt that my confidence is not misplaced, that our government will print its way out of this problem given enough time. The question, of course, near and dear to this audience is real estate. And when we look at the commercial real estate market, over on the next slide. You can see, and I think all of you folks are familiar with it, we've had pretty robust appreciation in real estate. We entered the current crisis at probably the lowest cap rates on commercial real estate in history. And my dog Gracie just came in the room. Right, Gracie? You gonna say hi? No? Okay. She gets annoyed when I'm on the phone, so just tell Lou. Okay. But anyway, you can see that the prices of certain classes of real estate, especially multifamily, have risen dramatically since the last recession. And there's as you can also tell, in the subsequent recessions after a run-up in commercial real estate, we traditionally get a correction in the order of 30 to 40% decline in prices. I know at this point, please, boys and girls, please keep all your razor blades locked up. Moving on to the next slide. We could see declines in this downturn larger than 2008. You can see on the left our projection for the unemployment rate. The base case unemployment we have is to go up 20% and then slowly work its way down over the following months, or I'm sorry, over the following quarters for the next 3 years. But you know, our stress case is that it's worse, and that would line up with some of the other forecasts out there, like President Bullard's. Of course, you can see the Great Depression. It took us basically 3 years to get to 25% where it peaked. So if we do get to 30% unemployment, that will be worse than the Great Depression. Again, as you can see, our base forecast is more optimistic than that, but still nevertheless in the Depression era zip code for unemployment. On the right, you can see the commercial real estate price index drawdown from the trailing peaks. And sure enough, we had a 20% drawdown back in the early 90s during the RTC crisis. And then we see the drawdown that we got in the great financial crisis of over 35%. So, you know, a forecast of a decline in commercial real estate prices of 30 to 40% seems extremely reasonable. The question is, where are we going to feel the most pressure? If we go on to slide 19, you know, and I do find this interesting because, or sorry, 18. The one before. I do find this interesting because, you know, our forecast of 20% relative to many is it looks a lot more optimistic than a lot of the other ones we're looking at. But nevertheless, TREP has done their work on defaults, and they assume unemployment rate will go to 10%. In that case, this is the TREP estimates on defaults of lodging, obviously ground zero for this crisis, retail, and then office, multifamily, and industrial, you know, are modestly impacted compared to the other two. If you use our assumption of unemployment, TREP was kind enough to actually use their model and tell us what the outcome looks like. At this stage, you are welcome to open something to drink and to calm your nerves. But, you know, this is pretty scary stuff. You know, the question in my mind today is, if you foreclosed on a hotel, what is it worth? I don't know. I'm not sure if you foreclosed on anything. I could tell you what it's worth. I might be able to tell you what multifamily's worth. I might be able to give you a guess of that. I might be able to give you a guess on office space, or certainly I could give you an estimate on industrial. But lodging, I'm not sure what these properties are really going to be worth. And retail, of course, as you know, will never be the same again. Retailers like Macy's, to be quite honest, we had on death watch already before we got here. We've been very negative on retail for the last 4 years, and have basically not been lending to any retailers at all, and staying away from commercial real estate property and retail. But this is just going to accelerate the decline of retail. And a lot of these retailers, as we all know, are never going to come back. So we do think there will be a surplus of retail space. We also think there'll be a surplus of office space. I mean, at Guggenheim, we're already talking about how we can reduce our office space as we've adapted to the idea that our employees can work from home. One of the beauties of having your employees work from home is that they never leave the office. So you can call them in the middle of the night and they're still there taking your calls. So this should enhance Guggenheim productivity, well as reducing our expenses for office space. And I think that will be too tempting for us to ignore. I don't think Guggenheim will be alone in figuring this out. By the way, just so you know, Lou Feldman is not the only stand-up comic in the financial world. Anyway, how this goes forward, you can tell that some office space I think will do well. Office space that's in suburban areas outside of the concentrated downtown areas will probably do better, because I think there'll be a hesitancy after the coronavirus to try to gather all your employees in one central location. So there'll be a move to sort of disperse people into various offices. By the way, that's one of the benefits we've had at Guggenheim, because we have 3 major offices and our investment division is divided up across those offices. So we did have an incident of the coronavirus in New York, but fortunately in Chicago and LA, no one was exposed. So I think that sort of stuff in the future will play into people's expectations, and large concentrated office spaces will be looked at as not optimal as an operating condition. Hang on. All right, Gracie, thank you. Appreciate that insight. So she obviously is concerned about office space. Moving on to lodging, though, I don't even know what to say about lodging. Obviously, it's going to be a long time before airport hotels come back to levels that can make money. It's going to be harder on hotels in places like New York and Los Angeles, where, quite candidly, one of the things I think Guggenheim has learned, I think other people has learned, that the idea of traveling around and flying around the country or around the world to have meetings is something which, I used to spend over 50% of my time doing. Our clients have adapted to the idea that we can get onto Zoom or just do a conference call or something. And, that's a tempting cost savings. And so we spent a lot of money on travel and entertainment. Certainly the entertainment side will stay intact in the long run. But the idea that, every month I have to fly to see a client so I can attend the board meeting, I think will become a thing of the past. Moving on to slide 20. One of the good things about residential real estate is we entered the crisis on a strong footing. You can see the vacancy as a percent of residential housing stock on the left, certainly below average since 1965. You can see private residential construction, which collapsed during the financial crisis, and we've never caught up. So the inventory of unsold homes is relatively light. It's not like what we had prior to the financial crisis, where we had 7 or 8 months of unsold homes. We had more like 3.5 months of unsold homes. And so, it appears that coming into this, the inventory supply demand balance is much better. Moving to the next slide, you can see that affordability, we did go to record highs of affordability. Obviously that was due to the large decline in housing prices, but also in part the large decline in mortgage rates. And as mortgage rates continue to fall, we're going to see this affordability index continue to improve. That's a good thing because when you look at the right side, we can see that the largest part of the demographic of our society are not homeowners. On the millennials who have never participated in home ownership because of affordability issues are moving into the higher earning years of their lives, between 35 and 64. You can see how with age home ownership rises. And so as these folks move to the right, and given the affordability of housing, we're going to have a robust demand for housing. So again, that's not to say that we can't experience a short-term air pocket. Any of us that need to close our house by the end of the week are going to have a really hard time finding a buyer, or finding a mortgage company that can give you an approval. But nevertheless, that short-term air pocket we probably will experience in housing prices is not likely to be sustained. And given the decline in interest rates, the likelihood is mortgage rates will eventually adjust lower after we see credit spreads decline and the backlog for refinancings clear up, which is obviously jamming up lenders and limiting the ability to do mortgages. One thing I would note here, we didn't include it, I wish we had, is what about interest rates, right? Everybody has made the mistake, practically everyone, that interest rates are low. I'll never forget giving a presentation for a client back in around 2004, and I showed a chart that showed interest rates over 250 years. And the average rate of interest over 250 years was about 3.5% on 10-year Treasury securities. And at the time, 5.5% was the Treasury rate. And one of the common things before I did it was I asked people in the room to raise their hands. Are interest rates high? Are interest rates low? Or are they just about right? And the vast majority of people raised their hands and said interest rates are low. And then I would show this chart and say interest rates aren't low. And so, people have systematically kept making the mistake of thinking that rates have bottomed. People thought rates had bottomed back in 2009. And people think that this sell-off in rates is going to be transient, and rates are going to go back up once the economy begins to recover. Again, we have a model, which I won't get into, but just so we can put a pin in the number, the model, which has accurately forecast rates for the last 20 years within a 2 standard deviation band, now tells us that the fair value for 10-year U.S. Treasury securities is minus 50 basis points, that is minus 0.5%. And the 2 standard deviation swing around that on the low side is negative 2%. Now, that all may sound crazy, but 2 observations I'll make. In 35 years, the model's not been wrong. And secondly, in every case, in every scenario that we've seen so far, the bond yields overshoot by 2 standard deviations. So negative 0.5% on the 10-year note is to be expected. And ultimately, a risk is that rates could go meaningfully lower. The reason I bring that up is that is going to be good for mortgage rates. That is going to be good for cap rates on commercial real estate. So on the macro side, the policymakers will be doing what they have to do to keep rates lower and to use it as a mechanism to help heal the economy, just as it has done since the global financial crisis more than a decade ago. So looking into the financing markets, I really want to spend most of my time here focused on one thing, and that is CMBS. And you know, we did have other stuff we included in the original presentation that Brian included, and I had him remove it because I said the presentation's getting long and we want to keep focused on real estate. So we're only going to talk about the CMBS market in securitization. If you look at the slide on page 23, you can see that the pre-crisis securitizations for CMBS, where the senior tranche, how much of the AAA senior tranche was rated, how big the mezz AAA and the junior AAA were, and then all the other tranches in the CMBS stack. You can also see the dotted line, the dashed line, which is an average of all the losses across the board on CMBS. You can basically see, using the current methodology of rating on the right, that virtually everything which is rated less than single A will be wiped out, and a significant amount of damage will be done to the single A tranches if we were to use the same sort of loss experience that we got in the global financial crisis. If it's worse, it'll be worse. One of the reasons I point to this is you're hearing a lot of debate today, a lot of which is being promulgated by you know, the private equity firms and real estate firms that that under TALF, that is the Troubled Asset Loan Facility, which was used during the financial crisis and is currently in place to be used again, that TALF should be used to support all the investment grade tranches of securitizations in CMBS and CLOs. The reality is that in the last crisis under TALF, AAA CMBS qualified for purchase, where the Federal Reserve provided you 65 or 70% financing, and private investors would put up 30%, and they got cheap leverage on their positions. They excluded everything below the senior AAAs. You can see there's good reason to. For one, the Fed doesn't really do credit work. They're not in that business. They candidly don't even really understand credit. In their minds, credit is the domain of the bank. They can't make a decision about financing, making credit calls on specific bonds. Two, the Federal Reserve is there to provide liquidity and maintain a stable financial system, not to influence market prices. The Federal Reserve is very sensitive to the fact that they do not want to create policies which distort market prices, because it is important as a matter of policy that the United States have well-functioning private sector financial markets that do not rely upon central government determining prices on credit. So the argument that, you know, gee, this TALF program should be available to all the investment grade tranches of CMBS and CLOs is nonsensical. The Federal Reserve is not in the business of providing credit enhancement. It is there to provide a sound financial system. And so losses associated with given securities are to be borne by the investors and not by the government in their mind. And so short of Treasury handing them money to credit enhance or provide guarantees, they will probably not consider financing anything other than the senior piece of the capital stack. Interestingly enough, the existing new TALF program, which is there for auto loans and credit cards, this time around they did not include CMBS. Not exactly sure why they didn't. I think there's a great deal of sensitivity on the part of policymakers that they not be seen bailing out the fat cats. So credit cards and auto loans are easily understood because the consumer needs them. The consumer doesn't really understand CMBS, and that is why the Treasury and all the programs that have been established so far have been primarily aimed at Main Street, not at Wall Street. And I think, given the political environment that we're in, I don't think the current administration or the Federal Reserve wants to open itself up to attack by people who may see any attempt to salvage these sorts of transactions or securities from coming under additional stress. And so at this stage, I would say they probably are just sitting on their hands, looking at what's gone on in the market, looking at the stock market, and feeling very satisfied that they've probably done enough for the time being, and ultimately will consider doing something if necessary later. But they are not going to be in a big hurry. Moving on to page 24, this shows you the losses of CMBS and the historical losses by vintage year. It was funny, and I don't want to, Brian and I work, Brian Smedley and I work together. He's fantastic. He came from Merrill Lynch. He was at the Federal Reserve prior to that. I don't hold that against him. But as an economist, and he runs our research team, and he pointed out to me that, in 2008, the rating agency structurally changed CMBS to intentionally make it safer. My response, and he said, and he pointed to the fact that look at how the losses came down after 2008. And my response was to say, Brian, that was a bull market. The reason that losses are so materially lower after 2008, in my mind, I think Brian is partly right, but in my mind, the biggest reason, contributing factor to that is the fact that we have had an incredible bull market in commercial real estate, and losses have been exceptionally low on mortgage loans. And as you see, the older the CMBS gets, you tend to see a ticking up of mortgage loss exposure with time. That is, as the loan matures, if you can't roll it over, it defaults, and so that isn't surprising. And then you also can see from our experience back before the crisis that the transactions which were originated closest to the time of the crisis were the ones that took the greatest loss. No mystery there. That's because commercial real estate valuations had reached their peak back in 2008, 2007 and 2008. And so that vintage of CMBS took it the hardest. So I don't see the CMBS market coming back real soon. It's kind of frozen right now, like I say, with the exception of the AAAs, where people have a high degree of confidence that the securities will not ultimately default. And I think that makes the prospect for the near term for commercial real estate financing extremely challenging. And certainly Guggenheim is available to finance things, but in order to be competitive where other things are trading currently in the market, the rates are probably substantially higher than just a month or so ago. And we would have to have a meaningful increase in cap rates in order to justify the financing even at those levels. Which means that that will put downward pressure on real estate prices. So, Stuart, you don't know many people that can talk that long without taking a breath, but here I am. I'm happy to take any questions or, any barbs that anybody wants to throw out.
Thank you so much.
Scott.
Go ahead and take it to the next section here.
Scott, this has been an extremely useful and very sobering presentation. And I could not imagine a more useful and insightful presentation for our audience. And I know I speak for everyone on the line in thanking you for your very significant and very erudite discussion that crossed everything from the virus to the macroeconomy to monetary and fiscal policy to real estate. Scott, if you will, I'd like, we're short on time at this moment, but I'd like to take you to a place perhaps that you haven't been in this presentation, and that is to translate, if you will, so much of the metric and so much of the outlook that you've provided into a discussion of social compact, social safety net, and the prospects for our most vulnerable populations here in the United States. And I'd like to simply preface that by suggesting that by some metrics, half of US households live paycheck to paycheck. Half of US households can't survive a $500 shock to their budget. We see the unemployment rate that's anticipated somewhere between 20% and maybe 1/3 of that order of magnitude. We've put some measures into place, some stopgap measures that relate to moratoria on eviction, on foreclosure, and the like. I know, Scott, that you're extremely well-versed and very deeply involved in efforts that relate to the homeless population here in Los Angeles. We know of the extreme magnitude of homelessness in the city. We know that those homeless are of very great risk with respect to the virus. And we know that efforts that have been undertaken so far as relate to the homeless are limited. It's not clear that these efforts put that population at lower risk with respect to the virus. So I would put the question to you this way, Scott. Bernie Sanders dropped out of the race today. Bernie Sanders espoused a very different social compact, a social compact that we couldn't have even imagined perhaps 8 years ago by a major presidential candidate. And in fact, both presidential candidates, Trump on the Republican side and Bernie on the Democratic side, had a great dimension of populism in their appeal. But standing where we are today, if the president called you today, or if the presumptive nominee of the Democratic Party, Joe Biden, called you today, and they said, in the wake of the severe, unprecedented economic dislocation that we have on our hands, in the wake of all of the dimensionality of that dislocation that you've described, and given the fact that the food pantries in California are open and staffed in part by the National Guard, given the fact that in Wuhan, during the worst days, food was delivered to Chinese households, given the fact that the fiscal distribution to US households is highly limited, given the fact that there could be hungry people in this country in no small number shortly, and given the fact that gun sales have skyrocketed in the context of this crisis. Joe Biden's on the phone, Donald Trump's on the phone, and they say to you, Scott, what's the message to the US people with respect to social safety net, with respect to social compact? What should I be saying? How will this look going forward through this great recession, through this, again, depressionary period potentially, how should this look over the next year or two relative to the way it looked in the 1930s, relative to the way it looked in Wuhan or whatever? So that's my question to you.
Well, Stuart, that's a big question. Let me observe something first before I give my advice. And that is, I worked closely with Mayor Garcetti to help raise the money to pass Proposition H, which was to provide a sales tax for the county and the city to raise funds to help homelessness. Unfortunately, one of the things that I asked the mayor at the time was, is this money going to be made available to private sector organizations which have experience in supporting homelessness and people who live at the margin, people like the LA Food Bank, people like the Union Rescue Mission, and I was assured that would happen. Disappointingly, the mayor has been held hostage by the city council and the county, and the money has been divvied up for use among the various councilmen to provide low-income housing within their districts. The programs being put in place or discussed have two problems. One is, of course, NIMBY, and the other one is the fact that based upon what is envisioned, we need to build apartments that would cost $500,000 each. And given the amount of money available, that would only probably get about 600,000 people off the street and will probably take about 10 years. The crisis is much more urgent than this. We are facing the possibility downtown in Skid Row that we could see pandemic sweep through the streets with all the homeless that are currently on the street. And so when I speak with the president or the president-elect, if he is the president-elect, my advice is that we need to urgently get FEMA-style support to these private sector institutions which know how to deal with the issues. We have to avoid policy programs which essentially become largesse used by politicians to try to buy votes and support. For anybody who's familiar with Chicago, I think people would be familiar with Cabrini Green. Cabrini Green was a massive public housing exercise and was designed to provide low and middle income families housing. It became essentially a ghetto. And in that ghetto, you would trade political influence to get people housing. I think, or private organizations that are just handicapped for funds, would be able to address the issue. I think the short-term answer is get these people off the streets. And we are seeing some of that from in the current environment, but we need to get people, we should probably work with hotels that are empty or motels and put these people into place. We need to, I think, help the private sector provide the support services. Great institutions like UCLA and USC and Pepperdine are already involved in helping to address the homeless issue in the area of medical services, dental services, legal services, and organizations, as I've mentioned, the Union Rescue Mission, are providing psychiatric services and helping people with job placement. We have to, of course, bridge the short-term problem of keeping people who are on the bottom rung of the ladder in terms of social stability, those people you mentioned, Stuart, who don't have enough money to withstand 2 months of unemployment. And that's one of the reasons that I favored expanding the unemployment insurance program more dramatically, and not spending money sending out $1,000 checks to people. I think that we need to have a more targeted response to this. I think job training obviously would be extremely good, and we should encourage job training through incentive systems. We have to bridge things between here and there. But one thing that I would say, Stuart, and I hope you don't mind me doing this, but I know that there are many people who are watching today and have taken their time to allow me to discuss, the view I have of the world. And I tell you that I'm honored to do it. But to your point, I'd like to make a very practical recommendation and suggestion, and that is that anybody who is viewing this, or any of your friends, if you would like to make a donation to the Union Rescue Mission in any amount, however big that amount should be, I am willing to personally match it. So we can turn to our government and ask them for help, and I think they need to be there for us. But the urgency of the crisis today calls upon all of us with means to share in our wealth to help those people who are most in danger. And I'd like to incentivize people to do that. And as I say, I will match the donation that you make.
Scott, that's a beautiful response, a beautiful personal response, and a wonderful offer. And I know that many of us on the phone will take you up on that, and of course feel as intensely as you do about the plight of those that are less fortunate. We are here at this moment in a period of spring, in a period of spring-based religious holidays. And many of us, turn towards the spring, towards a sense of hope, a sense of a better future, and looking to contribute very proactively, make the world a better place, and to make this a better future for us all. I know, Scott, that I have a daughter-in-law who's about to go into a hospital and deliver in the middle of this COVID crisis. And of course, this little baby's parents, are so concerned as they face the world at this moment. So let me say this in concluding. Scott, we've gone about a half an hour over. It has been of tremendous learning value to us all. We thank you for everything that you're doing personally and everything that you're doing professionally. We thank you for your contribution to the educational mission of the University of California, to UCLA, and as our mission includes that of broader societal enlightenment, we wish you, Scott, personally, the very best as we move forward through this pandemic. We wish you great health, and we wish everybody on the phone great health. We hope very much that everybody is safe. We thank you for your connectivity to UCLA, to the UCLA Ziman Center for Real Estate. We will be back to you with more programming. We look forward to any commentary or insight that you have. We thank our chairman of the board, Lou Feldman, for a very significant contribution to today's program. We thank our wonderful Ziman Center staff and the staff of Guggenheim, and we wish you all a very good rest of your day. Stay safe. Thank you very much.
Thank you, Stuart. God bless you all.